I promise Yin and I did not coordinate our jackets today, but it seems we have similar taste. So thanks for coming. This in some ways is going to dovetail with a little bit of what Yin was talking about, because ultimately I am going to talk about the incorporation of new information into price. As I warned our hosts for the day, I'm going to start with some conceptual material. I'm not going to get very technical, but then we're going to end on some application of it, okay? Let me start with this, though. How many, by a quick show of hands, are familiar with the concept of wisdom of crowds? All right, good, about half. Now, I'm probably the only professor in the room, so I'm going to take the liberty of cold calling. Somebody who just put their hand up, how do you understand wisdom of crowds? I think we had one here, yes?
Right, so if we have a bunch of people guess the number of beans in a jar, and take the average is better than anybody's single guess.
All right, we get that over here? So it was beans in a jar in this case, and it was have a bunch of people in a crowd guess, and then the average or the median or some collective. Our average guess is going to be better than the guess of any one individual. Interestingly, it holds that it's better than even an expert individual. Thank you for that. We're going to break that down a little bit. I'm going to do it in a couple ways. First, the sort of classic story you hear about wisdom of crowds is very similar to the beans in a jar, and it has to do with cows. The original data on this, and the way the story is often told, is that many, many decades ago, at things like county farms, they would have cows, and they would ask people, guess the weight of that cow. And the person who guessed the closest apparently got to keep the cow, right? Well, somebody at some point, quite a long time ago, had the idea of, well, let's look at what the crowd does. They gathered all the individual guesses, and they found miraculously that the average of all those individual guesses was within 2 pounds of the weight of the cow, right? And this is sort of fascinating, right? What it gets is you get lots of different guesses. So I grew up in the Midwest within spitting range of a field of cows, so I might guess around 2,000 pounds. Those of you who happen to grow up in New York City and you've never actually seen a live cow, you might say 10,000 pounds or 15,000 pounds. You might say 200 pounds, who knows? And in the end, those guesses on the outside of the distribution are going to cancel out, and we'll get something that's around accurate in the middle. That's sort of the first version of wisdom of crowds. Wisdom of crowds 1.0. That's how it works. We get a distribution of guesses. The good one, or the crappy ones on one tail cancel out the crappy ones on the other tail, and then we get some estimate in the middle, a point estimate in the middle, which is about consistent with our unobserved solution, right? There's another wisdom of crowds 2.0, which would look stylistically something more like this. Not every problem we face in the world has a point estimate solution. A lot of them are much more complex. There is an unobserved optimal solution, but to get to that solution doesn't take just guessing the number of beans or the weight of a cow. It takes combining a bunch of disparate and unique bits of information to get to some solution. So in this case, our optimal yet unobserved solution is something that looks like a house, right? And then how do we get that information into the same place? So imagine we had 2 different groups, each having 3 people. Well, in the top group, you have 3 people who know a lot about L shapes. In the bottom, you have 3 people. One knows about an L shape, one knows about a triangle, one about a square. Which one do we want? Well, the wisdom of crowds isn't just about getting lots of people. It's about getting lots of people with diverse information to recombine that information into something that's going to look like our unobserved yet optimal solution. Both of these, Model 1.0 and 2.0, really speak to the importance of diversity as an underlying driver of the wisdom of crowds. And we're going to break down why that is right now. I am a social scientist, so if I were to give a social science talk about why is diversity so important for the wisdom of crowds, here's how it might look. So I'd say, okay, why is that group involving a person A, a person B, a person C? In my world, that might be, in my department, we have people trained in sociology, psychology, and economics. I would say, why is that group more optimal than one involved of just a bunch of Bs, just a bunch of economists, or just a bunch of sociologists? So I would say, well, to summarize about 50 years worth of research, we would say, well, diversity of people and opinions, it engenders creative problem solving. By increasing the breadth of perspective now in this group, improving the quality of ideas through extended search. We can now look at many different places. And in what's called enhanced collaborative memory, we can hold more in our collective intelligence. To positively affect learning and performance, and that's especially true when the environments we're in are uncertain and call for innovation. Now that's the social science aspect. I'm in a room with a bunch of quants, so I can give you something more like this. Given what Yin just showed us, this shouldn't look at all scary, but I'm going to walk you through it anyway, just in case it made you nervous. Okay? This is the math that underlies why the wisdom of crowds actually works. And it's really cool to see. Okay? It's most closely associated with a former colleague of mine at University of Michigan named Scott Page. He calls it the diversity prediction theorem. And here's how it works. Let's say, first I should say that what is on the left-hand side of that equation is in fact equal to what's on the right-hand side. We're not going to do that together here, just take my word for it. What we care about is, on the left-hand side, is what we want to minimize. It's our crowd error. So how far, as a collective, how far are we from the truth, that unobserved yet objective truth? Okay? Theta is that truth. It's unobserved to all of us, or we wouldn't need to guess. We wouldn't need to solve a problem. So it's unobserved, but it's what we want to get to. Now C, in this case, staying on the left-hand side, is our average crowd prediction, whether it's a mean or a median. In this case, we're going to say it's an average. Much like the beans, much like our collective guess when we're trying to estimate the weight of a cow. So over on the left-hand side, we take our average guess as a group minus theta, and we have our crowd error. So how far from the truth are we as a collective? Move now to the right-hand side with the first term. We're introducing now something new, which is SI. SI is each of our individual predictions. So with the cow, my SI was 2,000 pounds. Your SI was 10,000 pounds or 5,000 pounds or 800 pounds. We all have our individual SIs. And now that term gets SI minus theta and then averages that across all of us. So what do we have? It's average error. So it's how far are each of us individually from the truth on average. Yeah? We good? All right. Third term and final term, I'm going to call diversity, and here's why. We have SI again, so it's our individual guesses, the 5,000 pounds, 2,000 pounds, etc. SI minus C. So it's not theta now, it's our individual guess minus our collective guess. So now it's how different were each of us, so how different are our SIs from one another on average. Again, we're going to average out across. We clear? All right. So check this out. On the left-hand side, our goal of wisdom of crowds is to make crowd error as small as possible. We want to get as close to the unobserved but objective optimal solution as possible. So we want the left-hand side to be as small as possible. I'm telling you that the middle term, the average error, will always be big for complex problems. If average error is small, it simply means that we all got basically the right answer, and we didn't need to have a group in the first place. We just should have picked somebody at random and said, you solve this problem. So for any complex problem in the world, whether it's guessing the weight of a cow, guessing the number of jelly beans, or things that are far more complex, like guessing the price of a stock, or how the market is going to respond to given news, or what diagnosis to give a certain patient, any complex problem in the world, the average error, if we let a group solve it, is going to be big. So what does that mean for our diversity term? What does it have to be? Big, right? I think I finally heard somebody just say big. I heard a lot of technical talk over here. Here I finally just got big. We have something small on the left-hand side. We have something big in the middle. We need something big then in the last term. If we want our crowd error to be small, we must have a lot of diversity in our guesses, right? Just to quiz you, what happens if we have average error that's big, because it's a complex problem, so that middle term's big, but diversity is small? What happens is this, right? We get a dartboard where we have lots of precision, but we're inaccurate, which means we're collectively precisely wrong. That's a problem. So what I want to do now that we're sort of conceptually on the same page with how wisdom of crowds works, how can we apply that kind of thinking, wisdom of crowds like thinking, to better understand price formation, and, sorry, I skipped ahead a little bit, and price movement in equities markets. That's what I'm going to play with. I'm going to do it via a hypothetical. My hypothetical is this. How will the market respond when news about Microsoft and news about AT&T become available? Right? Hypothetically, let's imagine that this is our market of investable equities. So those companies up on the top is the universe of what we're allowed to invest in. That's it. That A, that first row, is you as an investor. And then so your vector there, that binary vector, corresponds to your portfolio. I'm keeping it simple here. It's just, do you own it or don't you? You own it, you get a 1. You don't own it, 0. But of course, we have the kind of data, and we could put in all sorts of other things. What's the dollar value? What's the percentage of your portfolio? What's the percentage of the ownership stake in that given company, et cetera. But for here, for our stylized example, we're going to keep it like this. We're going to fill out that market now with a bunch of other investors and show what their portfolios look like. So now we have A through G, who are individual investors. We have their portfolios across this universe of investable assets. And we can see what their portfolios look like. Now me, as a sociologist, all my research is related in one way or another to social networks. As soon as I see a matrix of any kind, to me it's a network. And this one's a network, and it's what's called a two-mode network because it has two kinds of actors. It has investors on one side and firms on the other, and then linkages between them which constitute investment stakes or ownership, right? We can do some cool things with that kind of matrix. If we just think about some very basic, back to your high school matrix algebra, we can multiply that matrix by its transpose and get a square matrix that looks like this, where it's now investors by investors. Now the cells in that square matrix are how many common investments these two investors have in common, right? So G and A have 0 investments in common. C and A have 3 investments in common. And of course, the diagonal is just how many investments does this given investor have. This is an example of that applied to, who knows, maybe some people in the room, looking at the holdings of a subset of hedge funds which report to one of the commercially available databases, TAS. Here, the size of these nodes, and you can sort of make out some of the names. The size of the nodes correspond just to the size of the fund. But then more importantly, the distance between the funds, or the distance between the nodes, correspond to the similarity in their portfolios, right? And then we get a similar structure that we see in all kinds of social networks, whether it's cliques in a high school, or neural networks, or electric grids, anything. We see these small world structures emerge, where we have a bunch of funds who look very similar with respect to their portfolios that make up a little island, and then some other ones over here, and we can apply clustering algorithms to see that, and we get pictures like this. Back to our original rectangular matrix, we can take that same matrix and just do the opposite, so take its transpose and multiply it by itself. And then we get a firm by firm square matrix that looks like this. Now the cells in this are how many investors do these two firms have in common. So Apple and Samsung in this case don't share any common investors. AT&T and Samsung share 3 common investors. And then on our diagonal is just how many investors does that given firm have. So how many does it share with itself. So we can apply that to some data. This happens to be from one quarter, I think, in the mid-2000s, which is the Tiger Cubs hedge funds. This is what did they have in common at the time. So those little nodes are individual firms, and they're held by individual funds within that. The bigger those nodes get, the more central they get in that network plot. It means simply that more of those funds, more of the Tiger Cubs, happen to hold that at that given time, right? So we can do that at a much larger scale and do it across the entire universe of investable equities. This is using 13F data, which I'm sure most of you are familiar with. So any fund, any institutional investor over, I think, $100 million is reporting its long holdings at least. So we can apply that same concept to this. We can map out the entire network or ownership structure of equities. And what's neat here is that we see individual firms who get located close to one another in this space, not as a function necessarily of industry or their size or anything else, are traditional factors, but simply as a function of they're held by investors who themselves are similar to one another. And then we can sort of map this over time. But I told you I was going to tell you a story, a hypothetical story about AT&T and Microsoft, and then bring it back and make it relevant about news. So let me do that. We'll focus in first on AT&T. AT&T has three primary owners, as you see, A, B, and C. In addition to owning AT&T, those three owners have portfolios that are identical to one another. So in addition to AT&T, A, B, and C also own Samsung and Dell in this case. Okay? In my world, in my speak, that means they are structurally equivalent with respect to the equities market, right? All their ties are the same. We can make some assumptions based on that structural equivalence, and here it is. The three owners of AT&T, A, B, and C in this case, share or are more likely to share similar mental models about AT&T, so have similar interpretations of things that happen or are associated with AT&T. Share similar models about the market at large. Why would that be? Well, because they all showed up in the same place at the same time, right? You all showed up here today in the same place at the same time. It's likely that two of you chosen at random views the world similarly than one of you chosen here and one random outside, yeah? And see that these three owners of AT&T are likely to pay attention to the same things at approximately the same time, right? Because that information or news or whatever it might be that they're paying attention to, it means the same thing for their portfolios. Independent of their mental models, they just should be paying attention to the same things at the same time because they have the same universe of stuff that they care about. So then we're going to make a proposition, which is market responses to news or new information about AT&T are likely to be highly synchronous due to that similarity in attention, right? But they also carry the potential of being wrong due to similarity in perspective, that lack of diversity. So we have the potential for that. By contrast, Microsoft has three primary owners. In addition to owning Microsoft, these three owners have portfolios that are structurally inequivalent or very different from one another. So now we're going to impute meaning to that. Once again, the three owners of Microsoft are less likely to share similar mental models compared to the owners in the case of AT&T. B, they are less likely to share similar mental models of the market at large. They might be similar, but again, we're speaking relative here to the case of AT&T. And C, these three owners may not pay attention to the same things at the same time, right? They showed up at a different place in the market at the same time, which means they are different in some observable way with respect to their portfolio. We're going to then say maybe even a lot of unobservable ways too. They're paying attention to different stuff at different times potentially. So what's our proposition there? Well, market responses to news about Microsoft are more likely to be asynchronous due to differences in attention of the owners of Microsoft and or diverse due to differences in perspectives. So we'd expect something more like that, where we have less precision, but as a group, more accuracy on average. Back to our beans, back to our cows, whatever it might be. So remember back to our equation, we wanted to minimize our incorrect market response. We wanted to minimize our crowd error. We know we have a complex problem, so the average error will always be large. We want to jack up that diversity term as a result. In this case, Microsoft, we believe, has a lot of diversity in its ownership. AT&T has very limited diversity in its ownership. And here, note, you should know by now, I'm not talking about diversity in the colloquial sort of traditional ways. I'm not talking about racial or ethnic or age or anything like that. I'm talking about structural diversity in terms of their position in this ownership network, right? All right, so what me and my team of researchers back at Northwestern have been doing for a while, in addition, of course, to just understanding that structure over there on the right, plotting it over time, trying to figure out what are the topological features of it, how does it change over time, what can we learn from that on a macro level. We're also using now information from Ravenpack on news to ask that very question I opened with, which is how can we use this structure to learn about the way new information is incorporated into price. So one of the first things Yin said, as we want to know and have better estimates about the way new information is going to be reacted to in the market and ultimately incorporated into price. What we're after is trying to explain variance. So we're using the Ravenpack data, which is excellent, to tell us exactly when all sorts of different types of information show up in the market. Right? Some of that information is more endogenous in that maybe the market might have known a little bit about it. Some is purely exogenous, like a death. well, you guys know this stuff better than I. I'm going to show you, just in the interest of time, so maybe we can get a few questions in here too, data and results with respect to two categories of news. One is stock buybacks, which traditionally we expect to have a positive response in the market. And one is earnings below expectations, which again, traditionally we expect to have a negative response in the market. So this is all firms. This is aggregated data over a number of years. But on average, what we're looking at on the vertical axis is the cumulative abnormal return. And then, of course, on the horizontal, this is a standard event model. So it's event day 0. You see the line. And then what is the return prior to that, going back to about 10 days? What's the return up to 30 days? Yeah? Unsurprisingly, what we're looking at right now is that when a firm announces a stock buyback on that day 0, we see a positive response in the market, as we would expect. Now we're going to use sort of our methodology about position in that network of ownership. What does it mean to span ownership clusters if you're a firm? What does it mean to be owned by, in the present moment, investors who themselves are dissimilar? The red line here is investors who are similar to one another. They hold portfolios that are highly overlapping. What do we see the market response? We see it happens much faster and much higher, right? Magnitude's bigger and speed is bigger. In the latter case, the blue line is dissimilar investors. And this is holding constant things like number of investors. So this is just, do the investors in these companies, are they similar or dissimilar to one another? The blue line is they are dissimilar, structurally speaking. You see, again, a positive response, but it's much, much slower, and the magnitude is smaller. The second one I'll show you, and then I'll wrap it up, is, as I mentioned, revenue below expectations. This is all firms over a period of time aggregating data. Same idea, same standard kind of event model. As expected, we see a big negative market response in terms of cumulative abnormal returns right around that announcement. When we split, again, based on what is the position of that firm within this ownership structure, what do we see? The firms that have revenue below expectations, that have similar investors, are having a much more pronounced negative response. And in this case, we get drift. So they are responding very quickly, very rapidly, and potentially not very accurate, right? So after about 10 or 15 days, we have a drift in that price back up, as opposed to these firms that have dissimilar investors. What does their response look like? Well, it's coming down, as we would expect, but not to the same magnitude, and we don't see nearly the same level of reversion or drift back, right? What do I want to end with? Remember the cow. Dissimilarity, heterogeneity, diversity, no matter how we want to call it, is fundamentally the driver of wisdom of crowds and why it works. What I do in my research is I didn't come at you with any sort of new data per se. I came at you with a different way of thinking about the data that you already have in front of you. I appreciate the time. I'm happy to answer any questions. And I also am around for the rest of the day, so feel free to ping me.
Scott Page in his work talks about diversity and independence. What are the differences between the two?
So the differences between the two are, well, they're orthogonal concepts, but the idea is to preserve diversity, we need independent thought. So where a diversity prediction model or a wisdom of crowds model breaks down very rapidly is when we have groupthink. So we have non-independence of thought, right? So we might have very different people, but as soon as person A's opinion or belief becomes influenced by person B, then we have an unnatural narrowing or sort of homogenization of beliefs. And then it doesn't matter how big or diverse the crowd might be, we will get people who converge on potentially a wrong solution. So when Scott is talking about the importance of diversity, the assumption is that we have independence of those opinions, so we actually maintain that diversity.
Are you going to be around during lunch?
Yeah, I'll be around. Please. Oh, sorry, I should wait and let them do it.
In your study on both the positive and the when you split the blue versus the red,
Yeah.
what is the spread on each of them? Because you only show the average.
Yeah. All of a sudden, I'm not responding. The confidence intervals are similar to what you saw, because there's a lot of data we're talking about. So we're aggregating these events over a number of years. I wish I could go back. I was showing the confidence intervals on for these, and they look very similar in terms of the confidence intervals around these. I should have put them on, but I'll get the research up and have the correct graphs that way. We don't see significant differences in the variance around these by those two categories, the blue or the red, which I think is where you were going. Yeah.
You have a question?
A question follow up on the red here. Do those two universes add up to the?
There you are. Sorry, you could tell I had no idea where you were.
Sorry. Just a housekeeping question.
Yep.
Do the red and the blue universes add up to the total universe you're looking at, or are those sort of subsets of your total universe and sort of the two extremes?
So what do you mean by universe?
Right. So
universe?
you showed us two slides before. Yep. There's this slide and the one before.
Yep.
This here is where you break up the observation
yes.
set
Oh, yeah,
into
yeah.
two.
So this
and
is,
I'm wondering if this is the same as the whole.
It is not. So this is the top 20th percentile and the bottom 20th percentile on this measure we've developed and continue to refine.
So how are you quantifying these two groups?
What's the underlying math? Let's hang out at lunch. We can go through it. As I mentioned, the tricky thing about this is not sort of the matrix algebra, which is quite easy. The really cumbersome thing is to figure out what is the right kind of weighting for these. So when I put up those binary matrices, do you own it or not? Well, that's really not going to do you a whole lot of good, right? Because a large ownership stake means a lot more than a small ownership stake, and a large fund who has a small piece, yet it represents a large ownership stake, means a lot more than maybe a small fund that has a large ownership stake in terms of its portfolio. But then you have to factor into, well, a small fund that has a large chunk of, say, Microsoft, even if it represents a relatively small portion of Microsoft, they might be more attuned to Microsoft right now. So how do you apply which weights, which is really a cumbersome problem, and the type of thing that we do, just automated simulations to try to hone down on what's right.
Time for one last question over there.
So if I understand correctly about the incorrect response or the error you're trying to, and you're looking at event here in days and how far out, but you get out a month later and it kind of converged back.
Yep.
How do you kind of think about the high frequency of maybe a news event, but maybe the investor is thinking, I've got a 3-month or a 9-month or a 5-year investment horizon. How does that kind of play back into your model?
It doesn't at all right now. That's the kind of thing that I push back to you guys. And I says, how does that play into your investment model? It's a great question. It's the type of thing that we're interested in examining. And we need people from your side of the world to ask those very questions. What are some of the practical on-the-ground implications of this? I think it's interesting that we see drift, but why do we get that drift in this case? I'm much better at explaining why that quick, large magnitude reaction can happen right away. Why does drift happen then to get back to it? Well, it's consistent theoretically with the model, but on the ground, do we know if it's because, well, new investors are coming into play? And then, of course, how do we translate that into a portfolio where people have different mandates and different horizons? Not my area of expertise, unfortunately, but that's why I like to leave this stuff in your hands and see what you do with it.
Yeah, this was a lot of fun and educational at the same time. Thank you very much.